Okay, welcome, Jane.
Thank you.
And you have the ability to share your screen.
Okay, I will go ahead and do so. Can everybody see that?
Yes.
Yes.
Terrific. So I did meet Jack via Zoom last year, and obviously Sarah and I have been working together throughout the audit, but it's nice to meet you, Pam, and Denny. Did I get that right? So it is nice to meet you both, and thank you very much for having me and for having asked us to do your audit again this year. What I'm going to do is go through a few key points in the audit, and go through my required communications, and then, you know, if you have any questions, please just feel free to interrupt whenever. So our responsibility as your auditors is to express an opinion on the financial statements. It is a clean, unmodified opinion. It is your responsibility as the board and management for everything within the financial statements. And that includes your significant accounting policies, which are in note 2. There was nothing new and nothing changed this year. This is the first year in probably three or 4 years that you haven't had any changes, which is kind of nice. But there are additional changes coming next year. So we didn't encounter any transactions or anything that were lacking authoritative guidance. Everything was reported in the proper accounting period. And if that is too much of a distraction, my neighbor is mowing their lawn, I can shut my windows. Your significant accounting estimates are, of course, the useful lives of your property and equipment. You, as a community access station, change out your equipment and make significant purchases all the time. So that is a pretty significant estimate. Also, the fair value of your investments. Your sensitive disclosures, these, you have some of them that are pretty consistent year to year. Of course, your significant accounting policies, your liquidity, your franchise fees. But this year we had a couple of new ones that are significant, and that is the Paycheck Protection Program note, and also contingencies. The contingencies footnote deals with the effects of COVID on the organization and your investments. We didn't encounter any difficulties whatsoever in dealing with management during the course of our audit. We have provided some proposed journal entries. I'm assuming that they either have been or will be made to your financial records soon.
Yes, they have already been made. Karen, our bookkeeper, was in yesterday.
Terrific, terrific. And, you know, none of the misstatements really resulted in a material misstatement individually or in the aggregate. But it is important that you do make them unless you have any significant, you know, questions or issues with any of them, because you want your financial records to reflect what your audit, you know, and what's out there in the public eye. You want them to kind of match. There were no disagreements as far as accounting issues go. We have requested that you provide us with a management representation letter, and I will resend that with today's date on it, or I will send it to you with today's date so that it'll be dated the same as the actual board approval date. To our knowledge, there were no consultations with other accountants. If there had been, they would be required to contact us to make sure that they had all the pertinent information before responding to you. As far as discussions that we've had with Sue, okay. As far as discussions that we've had during the course of our audit, there was nothing that was like a condition of our attention. It was just the normal course of our audit. Anything that we discuss today is between us. And then once the financial statements are issued, they're open to public inspection, so anybody can access them. The Attorney General's office, once you file, puts your financial statements and your tax returns out on their website, so anybody can go get them at any time. In addition to that, your 990 is put on the IRS website. So just kind of be aware that this happens, and don't kind of be taken aback if somebody says all of a sudden, oh, I see in your financials, you know, this or that. Any questions?
No.
So these are your statements of financial position or your balance sheets in the, in the public world. You'll see that there was a decrease in spending, and you received PPP funding this year, so your cash balances went up. Also, your accounts receivable, that is the franchise fees, and we've been seeing a slight decline in those fees over the last few years, and I would expect that to continue given the environment. So your receivables, that receivable is the actual amount that you got in, say, February-ish. So we know that actual figure, it's not an estimate. Prepaid expenses, the Castus was prepaid this year, so that caused the prepaids to go up. And usually that is insurances or subscriptions that you have paid up front, and either the subscription or the insurance policy lasts more than one, into more than one fiscal year. Your fixed assets, of course, that's depreciation, and you did have some dispositions this year. If there had been any additions, those would be reflected in that number there too. It's a net number. Your investments, which are designated, you can see that below. That increase was the investment return. All in all, you had a 12% increase in your total assets, which was pretty good for the year. The accounts payable, that's all a matter of timing. You pay bills the week before year end, and you have very few payables. You don't pay them until the following week, and you have a lot, which is basically what's happened here. Your accrued payroll will fluctuate. That's accrued pay time off. That's accrued wages for the pay period that spans both years. And that will fluctuate year to year. And then your lease agreement is nearing the end. So the straight line rent was amortized down to 0. You can see here that you have net assets. You have none with donor restrictions, but you do have net assets that are tied up in investment, in fixed assets rather, and you also have your net assets that are designated operating reserves. That's that investment amount up here. It corresponds. Any questions on that? We'll move along to your income statement or your statement of activities. You can see again right here, the top line, the franchise fees did decrease this year. And again, that's in line with what we're expecting over time as the cable providers change their allocations and such. Productions and other income, that's down due to COVID. Same thing with your contributions. Your investment return. We did see, and everywhere that I work with that has investments, I did see positive returns for the year, but because of COVID and the volatility in the market at the beginning of the year, they just weren't as high as the prior year. Then we see here your PPP loan amount, which was forgiven in full in December 2020. Because it was forgiven, we were able to take that into revenue this year. In here, in this number, the other income number is insurance settlement. And that I expect to be a one-time thing. I would expect to see that go back down to around the $3,000 level again next year. You can see that there was a significant decrease in your expenses too, and we'll get into the details of that in the next slide. But the key point here is you did have positive change in net assets, whereas last year you had a negative change in net assets, and that's a pretty significant swing. So here's your statement of functional expenses. In the actual financial statements, this will be a lot more detailed. You'll see columns for program, fundraising, and general and admin. But this summary is just for you to get an idea of where the significant changes were. You had savings in your salaries and related expenses, and that includes payroll taxes, benefits, the whole 9 yards. And that has to do with cost cutting, just basically to save money. Your depreciation went down slightly, and that's because you have more assets that are fully depreciated. The office supplies and expense, again, you had cost savings initiatives there. Legal fees, I think those are pretty self-explanatory. That's what the increase in your professional fees was related to. And then the web hosting fees, that's the Castas. Any questions there? Yeah, you can go. Here is your statement of cash flows. And again, you'll see your operating cash increased by $105,000 specifically due to operations, whereas in the prior year, you only had an increase of about $27,000. So that is a positive swing for you. Your investing activities, you did have a decrease in cash related to investing activities. Your purchases of investments have to do with interest, dividends, things that are reinvested. And you will have, your investment manager will make some purchases and sales throughout the year too. Any questions there? Okay, we'll move on. And I was joking when I said I didn't want questions. I do like interactive. So at the beginning of the presentation, I mentioned that there are new accounting standards taking effect soon. Your fiscal year ending December, it's actually moved. I think it actually got pushed out another year, but it may be this year. The leasing standard, basically what it says is that if you have a lease term that extends more than 12 months, we have to take the present value of all of those lease payments and put them on your balance sheet as both an asset and a liability. Depending on the terms of the lease, you may have an asset that's slightly different than the liability. If there are, lease incentives that we have to take into account, or if we have to straight line the rental payments in accordance with generally accepted accounting principles, or if you have any prepayments that you have up front, those would have to be amortized as well. So you might have slight differences there. We have to take into account the entire lease term, which means if you have an initial lease of say 5 years with an option to extend for another 5 years that you are likely going to do, and you make that determination up front, then we would have to do the whole 10-year period, not just the original 5 years of the lease. So that is taking effect, and I believe you are up for a new lease. So I just wanted you to be aware that that is coming.
We just renewed our lease at the end of the year.
That's what I was going to say, Sarah.
So we will have to make that adjustment for 2021.
So we'd have 4 years left on that lease.
Right, but we'll retroactively restate 2020 to make that change. It won't be a big deal, it's expected. I would need a copy of the lease agreement to tell you, be able to tell you how it's going to look. But I just wanted you to know that that is coming for next year.
Right, but this is strictly a balance sheet item, right? Because you'll have a corresponding asset and a corresponding liability, so it's net zero, correct?
Depending on the terms of the lease. So if you have graduated lease payments over the term of the lease, that will affect whether it's a net zero or not. If you have lease incentives, like say they forgave the first 3 months or something, or if you have other prepayments or things like that that you've made on the lease, that would have an effect on whether it's a net zero or not.
Yeah, we have an annual increase.
Yeah, so that straight lining will kind of throw off that net zero effect. And I couldn't tell you without looking at it and doing the calculation as to what that will be, but it would definitely have an effect on it.
But generally speaking, I mean, once you, like, I understand the sort of the policy here, you know, in a conceptual level, but as far as income statement impact, my understanding is there's no income statement impact other than our annual lease payment. Is that correct? Or would there be more of an impact based
There
on
will-
this?
Well, based on the fact that you have graduated lease payments over the term, then, so under generally accepted accounting principles, we have to straight line that so that your rental expense is the same for each year, regardless of how much cash you pay out. So that will have an effect on your income statement, just
Okay.
fact alone. Other than that, if there are no other, you know, lease incentives or anything that are factored into this lease, then the rest of it would be net zero.
Right. So, and I'm not asking for specific numbers. I'm just thinking out loud. So if because our lease agreement calls for a 3% escalator each year, pretty straightforward. But you have to straight line it across all the years. So that means that from an income statement standpoint, we might be recognizing a lease expense higher than what we actually pay, right? So that way you can straight line it across all the years. Is that
Right.
conceptually correct?
For the first half of the lease, then yes. And the second half of the lease, you will be incurring a lease expense less than what you actually pay.
Right. Okay. Yep. I get that.
And so that's how that will be affected over the whole entire course of the lease.
Right. So that after 5 years, the whole thing nets out to zero. It's
Correct.
just essentially it's for the lack of a better term, it's a timing issue, right? Like
Yep.
like on paper, you're overpaying first half, you're underpaying second half, like, you know, just on paper.
Right,
Yeah.
exactly.
So
And
when you take that whole like 5-year term and figure out the total amount you'll pay, and then you split it out evenly over the course of, is that how you do that? Is that what you mean by straight line?
exactly. And so the asset and the liability. So what the basic liability is the net present value of all of the remaining lease payments. So that will be put on your books as the liability. The asset side of it equals the liability plus or minus any adjustments. In this case, it would be plus or minus the straight line rent. So your asset and your liability won't exactly be equal. And the net difference will be into rent expense.
Okay. Yeah, so that's something, that is something that, so here's a question in terms of presentation, because obviously for management purposes, we get our numbers out of QuickBooks, right? Which are not account numbers. And so, but in QuickBooks, so I'm just thinking out loud in terms of presentation, explaining it to the rest of the board. I mean, would you footnote something like that in the financial statements? Like, okay, the sort of gap expense for rent is this number, but the actual rent expense was this number. Would that be a footnote item?
What do we put in the budget? That would, like,
So you're talking, I'm sorry, let me just close my window.
Right, because I'm just thinking about
Sorry about that.
us explaining to the board, like, well, we know that the financial statements say this, but we actually paid that, right? I just want to make sure that we can show that somewhere, like, this is actually what it is.
So yes, the notes to the financial statements will have a lease footnote or a contingencies footnote, which will include the parameters of your lease. We can certainly put in there any language that you like to further clarify, you know, that the payments are straight lined under GAAP. And you know, we can also discuss the asset and the liability side of it. They have to be presented at gross. You can't net them together for balance sheet presentation in the audited financial statements. But you may or you may not present them at gross in QuickBooks as you're doing your monthly review. That's up to you.
Right, right. Yeah, because I know in QuickBooks, we are just expensing the actual lease expense, like what we're actually paying.
Right.
Right. And we would not be, we're not at least in the, you know, in a sort of ongoing, for purely management purposes, we're not presenting what the number should be straight lined under GAAP.
Right. So basically you're going to expense the payments that you actually make.
Yep.
And then at year end, we'll propose an audit adjustment to,
Yep.
you know, to adequately record the straight lining of that. And then your financial statements, once the audit has been approved and the proposed journal entries have been accepted and recorded in QuickBooks, your numbers will tie out to the audit. But on a month-to-month basis, you won't be seeing that straight line.
Okay. 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 Hey, that's what, yeah, I'm sorry. That was a very sort of long, windy road. I just had to think that through.
That's
so that
why.
when we get the numbers each month and people ask, hey, what, you know, why do we have 50,000 in rent, but the financial statements say that we should have like 70 or something, right? Something weird like that. I'm
Right.
just thinking that through. Okay, thank you.
You're welcome. Are there any other questions? That is essentially my presentation. So I don't know, are you going to bring the audit to the board for approval, for the full board to approve, or are you going to approve it here, or do you want to work that?
I think the board will probably want to look at it and, you know, watch the overview and make a vote on it.
Okay.
Not
I agree, Sarah.
Yeah.
At a minimum, just to receive it and have the opportunity to look at it. It may be overwhelming, but at least at a minimum.
Well, everybody has it. I've sent
Yep.
it to them. So I'll send the recording along. Actually, I'm going to stop the recording now because we've had all our questions answered. I want to make sure that that's all straightforward.
Actually, I do have one question about depreciation I would like as part of the recording. Excuse me. So one of the questions that has come up is, as we've, as an organization, as Sarah has started to purchase the equipment and incur other expenses related to the build out of the podcast room,
Mhm.
you know, recording that properly in QuickBooks and because they're really capital expenditures and not operating expenses. And I just was wondering what communications or how should we sort of handle that to make sure that we're recording it in QuickBooks properly so that we're not, you know, for the 20,000 of podcast room build out, we're not reporting it as an operating expense. And one of the big questions that come up is, you know, like, how do we handle the depreciation? Because we're not sure necessarily the depreciation schedule for some of this stuff.
Right. So for a nonprofit organization, all of your depreciation is straight line over the estimated useful life of the asset. So if you've got a piece of equipment, you expect that piece of equipment to, I don't know, computers are kind of like short-term things with maybe a maximum of 5 years, whereas something like lighting equipment might be, I don't know, 10 years. It would be depreciated straight line. So if you bought it in, you know, say May, you would depreciate 7 months worth in the first year, then you would depreciate 12 months each year going through till the final year, and then you take the remaining 5 months. So it really is determined by just an equal amount every single month. So you can make an estimate of that depreciation, but if you're making a purchase that you know should be capitalized in accordance with your capitalization policy, then that should definitely be recorded as a fixed asset on your balance sheet rather than being put into expense.
And Karen knows that. Karen, Karen takes care of our books. And I tell her, this is equipment for the podcast room and she knows how to add that into the QuickBooks. as an
Right, because we just want to make sure, because I know when we were doing budgeting, the question was,
How do we?
how is that going to impact the depreciation number between things that are rolling off, right, becoming fully depreciated,
I think we
and
updated
disposition
that asset list
versus,
a lot this year.
yeah.
Yeah,
We did.
I know that some of the assets were disposed because they're either no longer in use or you otherwise got rid of them or something. So yes, we did look at that. We did dispose of some things, and that should be done every year. We should be looking at that, asking the question, and making sure that you no longer are depreciating or listing things that you just don't have anymore.
Right. We
And
went through a full inventory too.
right. So, I mean, you can make an estimate. If you're buying $50,000 worth of equipment that you're going to depreciate straight line, and you bought it mid-year, you can make an estimate on that depreciation. And we'll adjust it at year end. It's not a big deal. But as far as for budgeting purposes, budgets are not cash flows anticipations. They are an anticipation or an expectation of what your net profit is going to be. So the budget wouldn't necessarily include things like purchases of fixed assets. They would include the depreciation on those assets.
Right.
And then you would want to separately maybe make a cash flow projection, which would be different than your actual budget.
Right.
And that would include the purchases of fixed assets.
So, but now leasehold improvements, because we did redo a room, wasn't a lot of money, about $3,500. That gets depreciated at a different time, on a different timeline, doesn't it?
Right. So if you're doing a leasehold improvements, it depends what you do. I don't know off the top of my head what you've done for $3,500. If you're just painting a room, you can expense it. If you're doing major changes, structural changes or electrical or something like that are permanent, then you would amortize those leasehold improvements over the remaining life of the lease.
Oh, okay.
Right. So if you did that in 2020 and you still have 5 years on your lease or 4.5 years on your lease, that's what you would amortize that over. Because the expectation is if you're making a structural change or doing something permanent to a space, you can't take it with you when the lease is over.
Right.
Sure.
Right.
Well, you can, but it'd be relatively hard.
Yeah, you might
If
be
we
able
have-
to put the equipment or something, but
You have a big truck.
Do
Yeah.
you have a schedule, like, would we lump the cost of all of the test equipment, right? The table and the microphones, and do we lump all that together and as one fee, the total cost was $17,500. Do we lump that and then split that out over how many years?
well, if you're doing it for budgeting purposes, then by all means do that. I wouldn't necessarily, if you're buying different things that may not necessarily have the same life or that could be disposed of for various reasons, either it broke or it is just no longer, it may be obsolete or something. It may or may not be disposed of at a separate time than the other things in that renovation or whatever. I would not necessarily list them and depreciate them together on your fixed asset schedule. But if you're doing, if you're anticipating your budgeting and you want to calculate depreciation for the coming year, you may just lump that together and say, okay, we're going to depreciate all of these because they are leasehold improvements and we only have 4.5 years left. We're going to do it over the same time frame.
So capital would go also in accordance with the lease? Or is that, like, they might last.
No. No, leasehold improvements would be the only thing that you would do in accordance with the term of the lease. Because like I said, you can't take them with you.
Sure.
So at the end of the lease, assuming that you're not going to be in that space anymore, you would want to be done with those assets, basically.
Right.
You would want to have expended all of those. Any equipment that is you can take with you if you move, you wouldn't want to lump that all together and depreciate that over the life of the lease. You would want to do that, you know, based on the actual estimated useful life of that piece of equipment.
And is there a schedule somewhere of usefulness?
Yes, what there is, you know, there's the IRS useful life, there's generally accepted accounting principles. But really, you know, like I said, if you're buying a piece of computer equipment, maybe a laptop or something, that's going to be a maximum of 5 years. They become obsolete very quickly. You may even make that shorter. It might be 3 years if you generally swap out your laptops every couple of years. If again, you have like lighting equipment or production equipment that you know is going to be around a bit longer than that, it might be 7 to 10 years. And it really depends on what the equipment is and what you feel the useful life is.
Yes, Sarah, in the last set of audit financials on note 2, there's kind of a broad schedule, like computers, like 3 to 5 years, studio equipment, and there was listed at 5. So we can.
Right, and you know, I think we shared the fixed asset listing with you when we reviewed it and reviewed those items, but I can certainly send it to you again so that you have it and you can see what assets are being depreciated over what length of time.
Yeah, we had, yeah, if that, we should have an updated list on that. And then I have, of course, new equipment to add to it this year and.
Yep.
Okay.
Thank you, Sarah. All right. Any other questions? For now, right? So we're recording for the benefit of our, for Christy and other board members and anybody else who might be interested. So I want to make sure that if you have questions related to the audit, that we get it on the recording. But otherwise, if there are no more questions, then Sarah, I'll have you end the recording in a moment.
Okay. All set? AM, Alden? Yeah.
Yep.
Okay.